Hello, everybody. Thank you for joining. Hope those in the US had a nice holiday yesterday. And thank you all for the feedback about the Sanjay video. It was a great honor to have him here in the studio and for him to take his holiday off to work. So appreciate you all. Let's talk about Octa today. A few very interesting signs. And as I've been saying for a long time now, we have all these dark clouds on the horizon. We have to wait for them to dissipate before we can jump in and deploy. But some strange things are happening. And this video is entitled A Question, not saying go risk on, but risk on in a recession? Possible? Let's look at some data. Whoops, wrong video. Here we go. So, and as usual, as we always say, this is edutainment, not financial advice. So the good news is today there's a lot of good news. So the last couple of weeks we had to start with the ugly news first or the bad news first. Today we're starting with the good. So let's jump in and go through some of the things that we see that we believe are positive. So first of all, a little bit of on-chain stuff. This is the monthly net position change for Bitcoin balances on exchanges, and it recorded the largest monthly decline on record with a net removal of 151,000 Bitcoin in June, and this was preceded by 73,000 Bitcoin net inflow, which was induced by the LFG sell-off. I added some, I hope the Glassnode team don't mind, as usual, I added some arrows to help train your eye on where to look. So back in May 2021, we had the miner migration. That's when all the miners had to up and leave China, so they had to sell a bunch of Bitcoin to fund their trip. Then we had the top sell in November 2021, where the experts moved their stuff around to sell the top. And then, of course, the LFG dumpage in May 2021. And now we are seeing this big, not your keys revolution, as I'd like to call it. Everybody is ripping as much as they can off of exchanges, just to be careful. And we'll talk about that and a few other things as well. Now, another very interesting thing, and over the last 5 or 6 years, I have never seen this phenomenon. So just to train your eye, I put a little green arrow in on the right. You will see the purple line and the green line are about to cross. This has never, ever happened to my recollection over the last 5 or 6 years. And the purple is deposits and the green is withdrawals. So you can see here, as a backup to the previous slide, people are withdrawing everything they can from exchanges. And again, we'll see what happens. And this is also despite suspension of withdrawals, which I'll talk about towards the end of this video. And the number of exchange deposits and withdrawals tend to have a very high correlation with spot prices, like we showed before as well. And a divergence between deposits and withdrawals can be seen. And this also is because of the caution, and everybody is focusing on self-custody right now. It's probably a great time to be in the Trezor business. So let's jump a little bit more. Fear and greed. Last week it was at 9 or 10. I can't remember exactly. And here it's at 19. So it's up 10 points. And the sentiment in the crypto market has been depressed for several months. But look at this. Fear and greed just hit a 2-month high of 19. And that is good. Now we're still in the extreme fear area, but we're pushing towards the fear area, which is typically above 20. And the market is slightly more optimistic than we've seen lately. And you can see that the temperatures are cooling out there in the market. So let's talk about AltCoins. Bitcoin's terrible performance in June into the first days of July, but the tide did turn when we kicked off the new week. And Bitcoin is now flat in July so far. In fact, a little bit up after a big spike recently over the last couple of hours. And altcoins have seen a sharper recovery than Bitcoin in the beginning of July. Now, although the movements are negligible this month, the indexes we follow typically are really outperforming Bitcoin. So you can see the mid-cap index is the best performer, up 5% so far in July. Small caps, 4.9%, and the large caps, 3.1% following closely, whereas Bitcoin is just up 0.5%. Let's see what that looks like in terms of Bitcoin dominance. So here you can see the Bitcoin dominance is still hovering around that 43%. It's been there plus or minus for the last week or two. So again, there's, you see my floor and my roof. Floor is about 39%, roof is about 51%, and we are in that range tightly. There's a lot of people had expectations for the current market conditions to drive Bitcoin dominance through the roof. We never even got close to the roof. So that's where we are. Now, in digital asset news, follow the money news. This is from CoinShares. James Butterfield. We had the record outflow, you may recall, last week. It was like 450 million, 425 million, something like that. And here you can see there's a little inflow. It's not a lot, it's 64 million, but it's a win and it's positive. And I can't remember the exact details, but there were inflows in places like Brazil, Canada, Germany, Switzerland, etc. And there's been a lot of ruckus in Argentina lately with one of the economic ministers quitting. So it's driving a lot of people to things like stable coins and Bitcoin in Argentina because they know hyperinflation is there. And I think Turkish inflation just hit 78% as well. So fiat is going down the toilet, as we know. So let's look at the detail here. So Ethereum, yes, 2 in a row after 11 weeks of outflows. They have had 2 in a row weeks of inflows, $5 million, breaking that very long drainage. And multi-asset, multi-crypto investment products added about nearly 5 million. And then you have some crumbs going into things like Solana, I think $1 million, Polkadot, $700,000, I should say, Cardano, 600,000, and a few others. So again, not bad. Therefore, it's in the good category. Now let's talk a bit about miners. We touched on this at the very beginning. The miners have been selling their holdings. We've been talking about that a lot, but we analyzed it a little bit more detail as to how much of their hodl bags they have been dumping and who has been dumping and what that translates to in terms of market price action. So the miners, after a brutal crypto winter chill, have really rocketed today. This is some of the names. Bitfarms up 17%, Core Scientific 13%. I always throw in MicroStrategy and Bitcoin there as a benchmark to see how they're relatively performing. But MicroStrategy even had a huge day today, up nearly 13%. Started off weak and then shot up. Hut 8, 12.2%, but still just under $2. And again, many of these names are way down. CleanSpark, 9.37%. But it's nice to see that rally, especially in light of the movement for Bitcoin, which didn't really move that much. But these things are beginning to rally because the market is applauding the fact that they are selling their Bitcoin, which basically shores up their liquidity and their solvency, and that gives the investors more confidence. My theory. So let's look at the miners who are selling hard. We put together a little bit of a table and to assemble this together. Here you see Core Scientific says it self-mined 1,100 Bitcoins in June, but they sold 7,200 in June as well. And they think they averaged about $23,000, bringing in about 170 million, which is big. So if you look here, you'll see just color-coded all the names: Argo, BitDigital, Bitfarms, CleanSpark, Core Scientific, Hive, Hut 8, Marathon, Northern Data, Riot. You'll see how their bags have changed. Now, the big ones, two things to note about this chart is, one, we don't have all the data for June yet. And second of all, some really did a huge dump, like Core Scientific and Bitfarms so far. We don't have the rest of the data, but I'd imagine maybe it'll be interesting to see if Hut 8 actually sold anything. Marathon and Riot as well being the trend of some of the leaders out there in the place. But a visual of what this looks like is much more dramatic than looking at it on a table. So we put together a little chart. That big, thick orange line is Core Scientific. You can see they have been producing a lot of Bitcoin, over 1,000 to 1,200 a month, and they were hodling them up to over 9,000 and then just ditched a huge percentage in a very short window of time. Same thing for Bitfarms, the other little skinny yellow line. And I'd imagine when we get the June data, we'll see some of the other ones doing the same thing. So it's pretty impressive. But remember, a lot of this selling actually happened in June. So July, we may not have the same sell pressure that kept a lid on Bitcoin. Very important. So let's switch gears for a second to talk about another piece of potentially good news. Is peak inflation behind us? So a big thank you to 42 Macro and the team for getting this to me. But here, last week, I did do a little bit of a chart on all the commodities that were actually down 20% or more this week. And this is from Darius Dale. And here you can see, and it was actually Brickhouse. Big thank you to Brickhouse who brought this to my attention. Thank you, Brickhouse. You can see here, they believe peak inflation is already past us and the trend will crash down very rapidly across different mean reversion models, Newcastle models. There's some Bloomberg information in there too, as well as macro median inflation projections. So this is all good, but let's look at one key indicator that I spoke about a few times. I said, if you want to look at inflation, look at oil. This is the oil chart. Now, I added a little yellow line and a big blue arrow showing you the price of oil. It was at about $92, $93, I think, on February 24th. That was the invasion date. Since that, it rocketed right up, hung around 125 for a while, and then bounced around. I think the mean for quite some time is about 110. That's the red line there is the 50-day moving average. But today, oil fell 10% and it's now down under $100. And as I say, there's a couple of things happening here. One is peak driving season is coming to an end in certain places. Holidays, people get ready to go back to school, etc. So there's less driving, less demand for oil. Also, a recession will reduce the demand for oil as we go forward. And this is a key driver of inflation. Therefore, I believe we are past peak inflation. So we'll see. Now, this was what we're really talking about today. And this is from Barron's. The Dow drops, the NASDAQ gains. How to make sense of this topsy-turvy market from Barron's. Well, when you look and dig into the actual performers today, when the Fed first started raising rates, we saw tech stocks like some of our favorites, Nvidia, Tesla, Google, Amazon, all take a hard hit, took it on the chin. And the first market responders as we manage money was to trim these types of risk on assets, these disruptive stocks. But now, as yields are heading lower, we'll talk more about that in a second too, it's making these same stocks, which have dropped 42%, 50%, 70%, 30%, etc., look like bargains after their big drops. So the question is the market going risk on? So we can't really tell at this stage. It could just be a flash in the pan, a little bear market rally. We don't know. There's more clouds on the horizon. We'll talk about some of those in a minute. But in terms of equity valuations, they are back under historical averages. So thank you, Brickhouse, again. So Bespoke Invest on Twitter posted this, and it showed equity market declines this year have brought returns over the last 5, 10, and 20 years back down to average levels. In fact, the S&P 500 annualized return of 9.1% over the last 20 years is nearly 2 percentage points below the historical average of 10.9%. So as we've been talking about, is the knockdown in prices have brought valuations very much under control, and now they're looking very attractive. And you see, I've been talking like Google trading at $2,000 is like the cheapest value stock in the world. It's also one of the fastest growing companies in the world too. So it just didn't make any sense. So that's what we're beginning to see happen now. Market is beginning to jump back into these disruptive names, these risk on names as we go forward. But there is bad news, and there's some ugly news too. So let's dig into both of those. First of all, despite the stablecoin risks, and everybody's now freaking out about stablecoins and a lot of FUD out there, you can see people are still plowing their money into stablecoins. This is represented from macro micro by the little blue line. That is the increased load in stablecoins, and the yellow is the Bitcoin price, still hovering around that $20,000 mark. But people are still going risk off, even though we've learned stablecoins can actually be risky too. So we'll see. Now, in addition, we had Bitcoin's worst quarter since Q3 2011. And I think at that time, I can't remember exactly, but I think Bitcoin was trading under $10. And now it's trading over $20,000. So, wow, it's been a hell of a 10 years. But again, we've never had a Q quarter as bad as this. And not to mention, the worst first half ever in Bitcoin's history is in the books. Also, as a reminder, the worst equity market opening in 50 years as well. So everything just got hit, between cascading liquidations on the crypto side to Macro worries, recession, inflation, war, everything hit at the same time. Are we coming out of that? I don't know. Let's look at some more data. So this is, first of all, QT from TXMC Trades. This is what quantitative tightening looks like. And this is the breakdown of all of the changes over the month of June. Now, the Fed was promising to slash $45 billion a month. And so far, they've only been able to take about $7.4 billion off the balance sheet. They did sell about $9.3 billion in treasuries, but they had to buy into some mortgage-backed securities by $2 billion. So at 9.3 minus 2 is 7.4 approximately. So you can see here the Fed is not able to tighten. What does that mean, ladies and gentlemen? Well, we could go back to QE soon, one day, but we'll see how they go. Now, the other thing to always bear in mind, we've never, ever, to my knowledge, in the history of the world, had QT at the same time as a recession and increasing interest rates and inflation. This 4-drink cocktail could leave you with one hell of a hangover. So be careful of that. We're going to monitor carefully, but something will break or something has to change. That is my thesis. So let's talk about the ugly news. Unfortunately, there is always some ugly news. First of all, it was a very touching video by Scott Melker today, and I respect him for having the courage to be out there and say what he did. So check his video out. He was exposed to Vault, which he promoted on his channel. But this is the list that we know of to date of firms, CeFi firms that have suspended withdrawals or are having liquidity issues. Babel Finance, BlockFi, Celsius, CoinFlex, CoinLoan, Volt, Voyager. Again, it is nasty out there. And this is not isolated to one company. It's hitting them all, triggered by things like 3AC and maybe some other things. But the other scary piece of news is, as I've been saying, there's more shoes to drop. This is an article from QCP Capital, written by Adam Morgan McCarthy. And a trading firm in Singapore said that the crypto credit crisis is not over yet. And there's a lot of exposure out of the financial center that is Singapore, and they have a visibility into some of other potential liquidations on the horizon. And they talked about Babel's insolvency and how that's impacting miners, and that could actually drive strain in other areas of the crypto market. And in addition, they also believe there are other large blocks of GBTC that could be sold in the market as well, beyond what 3 Hours Capital have already sold. And that could widen that discount again back to 35%. That's a good price to get it. So again, more liquidations could happen. This is all triggered by the 3AC stuff, BlockFi stuff, Genesis, etc. It's all interrelated, and there is more shoes to drop, according to those guys, and me as well. So first of all, let's talk about recession. Now, all of a sudden, everybody's talking about recession. It was pretty clear we were in it for the last month or so. But here, the Dow falls 500 points. This is from Forbes, as yield curve inverts again with global recession fears front and center. So strange to see such a strong market today when everybody's talking about recession. So what is going on? First of all, yield curve. Let's talk about this real briefly. Another chart. Sorry about all the charts, but it is Tuesday. And back on, I think it was April 1st, I put a little arrow in there. The yield curve inversion, and just a reminder as well, economists believe that an inverted yield curve signals an economic downturn or recession. And that is when I want to make sure I get this right. It's when the short-term yield is bigger than the longer-term yield, i.e. the 2-year, which is what I have here, has a higher interest rate than the 10-year. And in recent days, the 2-year yields have topped the 10-year yield. Very slightly, you can see on the right towards the other blue arrow I have, they are touching, but they're not fully there yet. But tribute to this economic indicator that's been around since the dawn of time. It nailed and forecasted the recession April 1st, 2022, and I covered it in the TA Tuesday as well. So it can't be any surprise. People say, well, this is MMT and things could be different, but maybe some of these old indicators still work very, very well. So we watch this carefully, but this has markets rattled. In addition, Europe, we talk about the recession is definitely here. Germany posted its first monthly trade deficit in over 30 years. I'll read the headline here. High energy prices and disrupted supply chains dent the image of made in Germany as May imports exceeded exports for the first time in over 30 years, which is crazy. I think exports fell by 0.5%, imports rose by 2.7%, and the gap is about €1 billion. But there's another problem too. First of all, they no longer have access to cheap Russian energy, which is going to ding them further. And second of all, the euro is in the toilet. So whatever they export, they're bringing in less for. So watch this space carefully. Sorry to everybody in Europe, but hopefully the ECB can continue what they do best and keep interest low and print more money, etc. But that's also why this is happening. This is the dollar index. So when you compare a bag of really bad turd to a bag of awful turd, the really bad turd actually does better. And that's what the dollar is. It's the best of the fiats out there. And this is why dollar has soared to a 20-year high against the euro and the other basket of currencies. Yen is in the toilet, euro is in the toilet, etc. Pound is suffering too. And the dollar index is through the roof. So a lot of people believe that while the dollar index is strong, Bitcoin cannot perform. And that is also true. We've showed that correlation multiple times here. So we'll wait and see. But it's getting to a point where as the dollar approaches $1.10, if it hits $1.20, that will crush, absolutely crush the US economy because it makes everything more expensive. So sorry about leaving you with some ugly news, but it's stuff we need to know. So we're seeing a combination of factors, some good, some bad, and some ugly. So that's the story for today. Thank you all for being here. And I want to give a shout out to Riley. It was Christopher's doggy that passed away. Sorry about your puppy, buddy. And thank you for being here. Hang tough.